everyone. Thank you very much for joining today's webinar. My name is Rav Singh, and I'm really excited to dive into the topic of 1031 exchanges and reverse 1031 exchange today. A really powerful strategy that can help you defer and save on taxes to grow your hotel investment portfolio. This special webinar combines our monthly call with KW commercial agents and insights from the hospitality industry, bringing together the best of both worlds to help you make smarter investment decisions. Now, I think most of you are already familiar with what a traditional 1031 exchange is, and I'm sure all of you know the importance of understanding the timelines, the benefits, the opportunities that come with it. Whether you're a hotel owner or you're just a regular commercial real estate owner or an agent that's working with investors, it's crucial to get the details right to avoid costly mistakes and maximize your ROI. So today, we're going to focus not just on what a regular 1031 exchange is, but we'll also talk about what a reverse exchange is. In a reverse exchange, you can buy the property first before you can sell your existing property and still qualify for a tax deferral benefit under the 1031 exchange. Now, I'm no expert. We have a subject matter expert who will be talking through us, regarding this subject matter. But as agents and as owners, this flexibility can be a game changer, especially in today's market where the inventory is still pretty tight and buyers are also competing at this point. Imagine a world where, based on the current market dynamics that's going on right now, you can negotiate pretty heavy and purchase a right property for you, so you can still take advantage of the 100% depreciation, in terms of your taxes for a strategy for 2025, and then still be able to sell your property to qualify for an exchange. And so we'll be discussing all that today. But before we dive into the session, let me quickly tell you a little bit about Singh Commercial Group. We specialize in hospitality investments, maximizing and helping our clients buy, sell, and maximize the returns on their hotel projects. So just, you can always contact us if there's any specific questions you have regarding our company or any specific needs that you have. But really as me being a real estate agent, from an agent's perspective, I've seen firsthand how reverse 1031 exchanges and just regular exchanges has been a game changer for my clients. In today's competitive market, we'll be able to quickly, we'll be able to move quickly, we'll be able to preserve capital and make smarter reinvestment opportunities, and that's absolutely a key in this market. So I'm really looking forward to sharing how us as agents can unlock this strategy to benefit for our clients and grow their portfolio. But from you, in terms of owner's perspective, owner's point of view, I want to tell you that taxes have always been a pain point. It's a major pain point. But relying on 1031 exchanges, why do we need to do that, right? We can do that so we can defer on those taxes. We can keep our capital working together and grow our portfolio without facing a huge tax burden. It's something that I've personally used, for my portfolio, and has been a game changer for me to expand my portfolio. So I'm really excited to dive into that. But really excited to also let you know that we have a subject matter expert who's going to be talking about this and going more into insights, on the 1031 subject. We have Todd Pajonas with us today. He's the president of Legal 1031 Exchange Services. He's a leader in the field of 1031 exchanges, and will be sharing his insights on how to leverage this strategy to maximize growth for the tax savings. But before I hand over to Todd, I just want to quickly cover some of the things that we'll be talking about in this presentation. So of course, we'll talk about timelines, we'll talk about requirements, both for traditional as well as reverse 1031 exchange. We'll also talk about how to grow your portfolio faster. I know that Todd has a few slides that he'll cover regarding the new tax law that has been passed by by Congress in regards to what the bonus depreciation could mean for you, for your portfolio. And so whether you're an agent or an owner, this webinar is for you today. Now, we want to make this presentation very interactive. So I'm encouraging everybody to ask questions in the Q&A section of this Zoom. And we'll have a live Q&A session at the end so Todd can answer a lot of those questions for us. I'll be monitoring it. If there's something that I can answer for you, I'll do that. Otherwise, we'll just leave it to the subject matter expert that we have, with us today. Plus, also, don't worry, you don't need to take a lot of notes because we are recording this presentation. So after the presentation is ended, we'll be sending you the slide deck as well as the recording with anybody who is registered on this seminar today. And so without any further ado, let's dive in. Todd, welcome to the webinar. And really, thanks for spending time with us today.
Hey, thanks very much, Rav. I appreciate the invitation and, look forward to diving into not just 1031 exchanges, but also talking about how reverse exchanges work as a tool. And if time permits, because we do have a lot of material to cover today in a short period of time, I'm going to do my best to give a general overview of the new tax bill that has been called the One Big Beautiful Bill. So we got a lot to go through, and plus we'd love to take some questions at the end. So thanks again for having me, and thanks to all who are on this Zoom call here.
Great. Thank you.
So I'm going to share my screen. Let's see.
Okay.
Okay, presentation mode. Okay.
Yep, we can see it.
All right, perfect. All right. So, the starting point of any discussion about 1031 exchanges, I've found, and I've been doing this 27 years. I'm an attorney. All I do is structure 1031 exchanges, my whole practice, my whole career for the past 27 years. I always think a good starting point of a 1031 exchange is to talk about the myths and misunderstandings of 1031 exchanges. Now, what a 1031 exchange does is it defers capital gains tax when you sell business or investment real estate and use that money to reinvest in other business or investment real estate. There are a lot of people who think an exchange is a swap, meaning I have property you want, you have property I want, let's exchange those. And while that's the original form of exchanging, and it is still valid, that's not what a 1031 exchange is. Normally, it's a sale or purchase with very little difference than a non-1031 transaction. So when you sell a property, Rav, somebody would hire you as their broker to sell the property, and that sales process would be not any real difference between a normal sale process for that property. Except that right before you actually went to the closing, the third bullet point down is it's the exchange documents that create the transaction. So that taxpayer, that seller who's looking to structure their transaction as a 1031 exchange, they would hire a qualified intermediary. That's the company I'm with, Legal 1031 Exchange Services. We're known as a qualified intermediary, and our job is to structure that sale transaction as a 1031 exchange and subsequently use those proceeds to buy a replacement property for the taxpayer. And again, that process of picking out a replacement property, the new property that they're going to buy, again, they would work with a broker to find that property, and the process is not any different than the normal process of trying to find a property. But we're going to find out when we go through all these, that there are rules for how to identify property, timelines, and all that. But the fourth bullet point, the last bullet point, is that the gain from the sale property, the relinquished property, is deferred into the replacement property. So although it would be great if 1031 meant you were being forgiven of the taxes upon the sale, That's
Right.
unfortunately not the way it works. That gain, I always say the example I use is picture your gain like luggage. When you move out of the property you're selling, you pick up your luggage, you carry it with you into the new property, and you set it down. So your gain follows you. Now, the idea is to exchange, 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 and ultimately, and hopefully we have enough time to go through it with the one big beautiful bill, is when you pass along your property to your heirs, you get the stepped up basis. So a lot of times people will ask, when do I actually pay this tax that I have deferred? And the answer is, with good estate planning, hopefully the answer is never, when you pass it
Right.
along to your heirs.
Right.
Okay. So in this next slide, this is the operative language of a 1031 exchange. And what it really says is that the taxpayer is not going to recognize a gain or loss if they exchange real property held for productive use in a trade or business or for investment purposes. And that property that they purchase also has to be held for productive use in a trade or business or for investment purposes, and they have to be like kind. So we're going to go through, especially that term next. What does like kind mean? Because that's another big misnomer. When people hear, the properties that I sell and buy have to be like kind, maybe someone is selling a hotel, and they've been in the hotel business for decades, and they're looking to retire and not have to manage a hotel anymore, and they'd like to exchange into something passive. Like kind doesn't mean if you're selling a hotel, you have to buy a hotel, or conversely,
Right.
maybe someone on this webinar today has other real estate and they want to roll that into a hotel. They're going to get involved. So maybe they have a shopping mall, a strip mall or something like that, or an apartment building. They'd like to sell that to fund the acquisition of a hotel. Like kind means that the property is held for business or investment purposes. It doesn't mean the same type of property.
Good.
Okay. So what this little pinwheel is meant to illustrate is what like kind means. And you'll see it has retail, office, industrial, vacant land, multifamily, single family home, even things like easements and air rights. Now, one that sticks out here is single family homes. If the single family home is held for investment purposes, it could be, maybe it's a lawyer's or an accountant's or a doctor's office, or maybe it's a rental house, right? So just because it's a single family home doesn't mean it can't be considered business or investment property. So like kind means any kind of real property interest. It has to be domestic in the United States, Guam or the U.S. Virgin Islands, but not Puerto Rico because it's a protectorate, not a territory.
Okay.
All these types of properties are considered like kind to each other. So don't get caught up on thinking that it means the same type of property. Like kind means held for productive use in a trade or business or held for investment purposes. A way of thinking about those two terms is held for investment purposes is the traditional landlord-tenant relationship. You own a property, you rent it to somebody else, or maybe you own a piece of vacant land and you're just holding it for appreciation. That's held for investment purposes, more passive. Held for productive use in a trade or business is maybe you own real estate and you have a hotel there. Your trade or business is the hotel trade, and that could be anything. You could own a warehouse for a manufacturing company. You can own a car wash. You could own a building that you house your restaurant in. What it means is your business, your real estate holds your business. So
Okay.
held for productive use in a trade or business is the one type of real estate that qualifies. Held for investment, which is generally the more tenant, landlord, or just held for passive investment purposes. And you'll see at the top of the screen it says intent. The best way to describe intent is your actions over a period of time.
Mhm.
So sometimes people say, well, how do I know if I just bought this property? How do I know that I can structure it as a 1031 exchange? And what I'll say is, first, 1031 exchange only defers capital gains tax. So if anybody on this webinar is somebody who does property flips, turn on cable TV and there's like about 350 shows on how to flip your house and things like that, and slap a coat of paint and redo the kitchen, and you can bump up your value 20%. Flipping is going to be ordinary income. If you hold property for less than a year and you don't have the intent to hold it for a long term, that's generally going to be ordinary income. And a 1031 exchange does not defer ordinary income. If you buy something and then you hold it for a year, but the year period is really just you renovating the property, the IRS will say, well, what was your intent? Sure, you held it for a year, but that whole year you spent renovating it. So you didn't really hold it for a year because it was an investment. You held it for a year because that was the period of time to renovate it.
Mm-hmm.
So that probably wouldn't qualify. But if I buy a building, I renovate it, and then I hold it after that for at least a year, and whether that's a house, a hotel, a strip mall, then that would qualify. So the IRS looks at how you act. Is this an investment property? Is it helpful, productive use in a trade or business? Or is it a property you're holding for short-term ordinary income, which doesn't qualify? Or the last category that doesn't qualify is personal use. You can't sell your primary residence or personal use property. There has to be investment use for it, and you can convert it. So if you have a house with a large amount of gain, it's more than the 250 or 500 if you're married for primary residence capital gains tax exclusion. You can move out and rent it for 2 years, and then it becomes an investment property that you can exchange.
Okay.
So,
2 years. Okay.
and 2 years. And by the way, on the back end, for those who might be exiting property, you can use 1031 exchange to buy a house, a condo, or a co-op that eventually you may want to move into, whether as your primary residence or a second home or a vacation home. You just have to rent that property out for 2 weeks each year for the first 2 years, and restrict your personal use to 2 weeks each year, or 10% of the time you're rented out. So there are a lot of people with planning ahead. They sell an asset, and they'll use some or all their 1031 proceeds to buy that house, condo, or co-op where they eventually may want to wind up either in retirement or as a vacation destination for their home. And it's completely legal. You just have to rent it out for 2 years. Okay. So, that's kind of the mixing of business with what you want on the personal side. So this next slide, rules to obtain a complete deferral. So the general rules are that you have to purchase replacement property of equal or greater value to the relinquished property. So again, some terms there. The relinquished property is the property that you're selling. The replacement property is the property that you're purchasing. And by the way, just for ease of this presentation, a lot of times I'm saying property that you're selling and property that you're buying.
Right.
You can use 1031 to consolidate. So you can sell a bunch of properties as long as you sell them all within 180 days, consolidate all that money to buy one larger property, or, the reverse, you could sell one large property and use that money to diversify and buy several smaller properties. So don't be misguided by my examples where I'm saying sell this and buy this. It's actually more flexible than that, and we'll try and touch on that as we go along. So the first rule to obtain a complete deferral, and by complete deferral, I mean that at the end of the transaction, the taxpayer pays no tax, is that you have to buy a property of equal or greater value. So if you sell for $2 million, you're buying for $2 million. The next bullet point is you have to reinvest all your net proceeds from the sale into the replacement property. So you sell a property, you have different costs. You have, Rav, you have the broker's fee, right? That's why we're here. We have the transfer tax in some jurisdictions. We have attorney's fees in some cases. We have title fees, all the fees that go into selling property. And sometimes you have to pay off a mortgage, judgments, things like that. That's the net proceeds. That's the cash proceeds. And that's what comes to the qualified intermediary as part of the exchange. All that money has to be reinvested into the new property. If there's debt, this is the third bullet point. If there's debt, you have to obtain equal or greater financing on the replacement property as was paid off on the relinquished property. So not the original amount. So if you have $350,000 mortgage on the property you're selling, when you go to buy, in addition to spending all the net cash proceeds, you also have to either take out $350,000 in debt on the new property or inject an equal or greater amount of cash from outside of the transaction, or a combination of the two. So you could take out debt of $250,000 and inject $100,000 into the
Yeah.
new deal, just so long as you're buying for an equal or greater amount.
Thanks,
A lot of
Todd.
people,
Thank you for
go ahead.
explaining. I was going to say thank you for explaining that, because I think a lot of people don't really understand that aspect of it. That not only are you taking the money in terms of the gain that you're making and reinvesting that, but if you have current debt on the property, you also have to take out new debt when you're buying a property.
Yeah, and that is a good point to make, Rob, because a lot of people think that the debt is going to be an expense. So it's just going to be deducted from the amount that they have to spend. And the reason why that's not true is because of the calculation of gain. What most people don't realize is when you calculate gain, in other words, the amount that you're going to pay tax on, it's your original purchase price plus capital improvements minus depreciation, which we call the adjusted basis, right? So it's your sale price minus the adjusted basis minus the expenses of sale. And what that amount is the gain, and that's what you would pay taxes on if you didn't structure it as a 1031 exchange. Debt has nothing to do with the calculation of gain. So whether you have some mortgage, a high amount of mortgage, a low amount, or none at all, it doesn't affect the amount that you owe as a gain when you sell the property. So what the IRS is saying, and the states, is that they'll allow this tax deferral as long as you recreate your investment somewhere else.
Mm-hmm.
And that doesn't mean getting relieved of debt. So
Yeah. And
purchase
if you don't
property of
mind,
equal greater.
I'm sorry if you don't
Mhm.
mind, just because I know this is once again a hot topic that a lot of people will have. Can you give a really very easy example of I own a hotel, right? I owe whatever money, as you were explaining again, just one more time.
Yeah. So one of the things that I think is important to look at is that first bullet point where it says buy property of equal or greater value. If you take your net proceeds after expenses and add the amount of financing, that's less. So that first bullet point should be buy for equal or greater less your transaction expenses. So to give you an example, Rob, if I'm selling, let's say I'm selling a hotel for $4 million.
Mm-hmm.
All right. And I have $200,000 worth of expenses to sell. That's I have a net sale price of $3.8 million after the sale. And let's say I have an $800,000 mortgage on it. So I get $3 million in net proceeds, plus I paid off a mortgage of $800,000. When I go to buy, the minimum that I need to spend for is I need to spend all that $3 million in cash, and I need to take out a mortgage of $800,000 or more. If I do that, I defer all the tax.
All right.
But what's important to remember is I can buy for less. Let's say I find a hotel I'd like to buy for 3.5, right? I use all my 3 million cash, and then I take out only debt of 500,000. I'll pay tax on the $300,000 remaining, right?
Got it.
That's what's known as boot. That's a term of art, not a legal term.
Mm-hmm.
So the requirement to defer all the tax is that you buy for equal or greater value, but you can buy for less. You just pay tax on the difference.
Thank you.
Okay. And the last bullet point is you have to receive nothing except like-kind property, and that bullet point is especially important for hotel transactions, because I've been involved in a great number of hotel transactions over the years, and hotels are when you sell a hotel or buy a hotel, you're buying a combination of assets. What you're buying is the real estate. Many times what you're buying or agreeing to is the franchise right. If you're a franchise hotel, one of the different companies that allows you to brand yourself as their company. And then also all the personal property, the beds, the TVs, the furniture, all that equipment that goes along with it. So when you buy a hotel or sell a hotel, you're not always just selling real estate or buying real estate. You're buying a mix of assets. So a 1031 exchange only defers the real estate component of that. So if you're selling a hotel, and you'd like to defer the tax, you want to push as much value that you can legitimately towards the real estate value. And the same thing with the purchase, although many times on the purchase, they want to push the value towards personal property, which is all the things that are not real estate, because you can depreciate those items faster. So a lot of times when you're trying to negotiate the sale of a hotel, it is a little bit of a negotiation between the seller and the buyer wanting two different things. The seller wants to push more of the value towards real estate if they're doing a 1031 exchange, and the buyer wants to push more towards personal property because they're going to be able to depreciate that faster and get a better tax treatment on their income.
Yeah,
right.
Agreed.
So next slide, I should say. So this slide, when you first look at it, looks complicated. Let me explain it, and hopefully it'll make a lot more sense to everybody listening. So in the beginning, you'll see my company's logo, Legal 1031 Exchange Services. That's us as the qualified intermediary. So we sit in the middle of the transaction. Our role as the qualified intermediary is basically threefold. Number one, we prepare the required documents to structure the sale and ultimately the purchase as a 1031 exchange. So we prepare the documents. The second role that we have is that we hold on to the net proceeds from the sale and use them to buy the replacement property. So we prepare the documents and we act as the independent escrow agent for the net proceeds. And three is, again, I started this by saying I'm an attorney, and we have other attorneys on staff, an accountant, a whole bunch of paralegals. We're all very tax-savvy people. We're just not allowed to, by law, give you tax or legal advice. That's not to say we can't give you information. We can't help you, and that's the third thing that we do, is we're going to hold your hand through the transaction. We're going to explain things just like I'm explaining here today on this webinar. We just can't give you tax or legal advice. So that's the role of a qualified intermediary, is to prepare the necessary paperwork, hold on to the funds in between the sale and the purchase, and help you structure your transaction correctly. Above us, you'll see it says exchanger. Exchanger is our client. Maybe one of you who's listening here today or one of Rav's clients. That's the party, whether it's a person, a company, an LLC, a partnership. That's the taxpayer who's selling something and eventually going to buy something in a 1031 exchange. Now, to explain this flow chart, the easiest way to look at this is to draw a line down the middle. If you look at the left-hand side of your screen, that's the sale portion of it. You'll see relinquished property. And the right side will become the purchase portion of this transaction. So if you follow the arrows from where it says exchanger, you'll see it goes to the deed and then an arrow follows down to the buyer. That's the sale transaction. So again, when you look to sell, you hire a broker, you get somebody who agrees to the purchase price, maybe you hire an attorney to negotiate the contract, you go to a closing, and before that closing, you hire a qualified intermediary to prepare the 1031 exchange documents. You go to that closing. It's a closing just like any other closing. There's really only two differences. One is there's some extra documents that structure it as the 1031 exchange. And two, the net proceeds comes to us as the qualified intermediary. And you can see that's that first arrow going from buyer. It's got the little dollar sign in it that goes to the qualified intermediary. That's signaling that the net proceeds come to us as the qualified intermediary. Now, at this point, that's when we look at the bottom of the screen where you see the 45 and 180 days. From the date that you sell the property, and I'm talking about the closing, so signing the contract does not start this time deadline running. From when you have the closing, you have a total of 180 days in which to buy the replacement property or properties. Remember, you can buy more than one. And within the first 45 days, you have to submit an identification form choosing what properties you may want to buy. And we're going to go over that next. So within that 180-day period, you have to buy the property. So let's say in this example, somebody sold a hotel, and what they're doing is they're going to buy, a different hotel. So they sold the hotel, they structured it as a 1031 exchange. We're now holding on to those funds and then they go into contract just like any other contract to buy that property. You schedule a closing. We send in that money to make that purchase, and then a deed goes directly from the seller to the exchanger to complete the exchange. So again, if you draw a line down the middle, it's a sale, just like any other sale on the left-hand side. On the right-hand side, it's a purchase, just like any other purchase, with the qualified intermediary in the middle preparing the 1031 documents on both sides, and the funds flowing through us within 180 days. Right? That's the structure of a 1031 exchange. Now, I talked about the identification rules. One of the documents that we prepare as part of the 1031 exchange paperwork is the identification of a replacement property. You have to provide a list of properties before midnight of the 45th day from when you close of properties that you may potentially buy. And there are 3 different rules that you can use to choose how many properties you're allowed to identify. So you can't just take a phone book of San Antonio and say, here's some of the properties I'm thinking about. You have to be specific. The 2 most commonly used rules are the 3 property rule and the 200% rule. The 95% exception, we're just going to touch on it for a second. It's really used by REITs and private equity firms doing large portfolio transactions. To put it in context, we do several thousand exchanges a year. We probably only get somebody properly using the 95% exception maybe once every year or 2. It's used that rarely. The 3 property rule says you can identify up to 3 properties regardless of their value. The 200% rule says you can identify an unlimited number of properties, but you have to give each property an estimated acquisition value, and when you add all of them up, they cannot exceed twice the value of the property you sold for. So if you sold for $2 million, you can identify for $4 million worth of property. And let's say you're exiting the hotel business and want to instead buy a bunch of $500,000 condominiums somewhere. And so if you sold for 2, that gives you $4 million worth of identifying power. At $500,000 each, you can identify 8 different properties. So the 200% rule is a diversification rule. When you're selling and you're looking to diversify and buy a whole bunch of smaller assets that add up to equal or greater than what you sold, the 3 property rule is generally used when you're looking to buy 1, maybe 2 properties, especially if you're looking to leverage up or buy for a greater amount. The 95% exception is if you identify more than 3 properties and in total they're worth more than 200%, then you have to acquire 95% of the value of all the properties identified. When it comes time to do an exchange, my colleagues at my company are always happy to go over this with people to make sure that they're, help them understand the rules, maximize their identification. And the idea of identifying more than 1 property is that sometimes identification doesn't mean entering into contract. So you could identify something, and then after 45 days, that becomes the universe of properties that you're allowed to buy. After the 45th day, if one of those properties is sold to somebody else or they pull it off the market, then what you're left with is the backup properties. So it's always important to have backup properties. Or during due diligence, you find there's an environmental problem, there's a title problem, something like that. Right. So when you make the identification, it has to be in writing, unambiguously describe the property, signed and dated by the taxpayer, and received by the midnight of the 45th day. And it has to be delivered to the qualified intermediary or to a party related to the exchange who is not a disqualified party. Pretty much everybody that the taxpayer is working with to help them sell and buy the building is a disqualified party. The real estate broker, the attorney, the accountant, all those different parties are going to be disqualified parties. Examples of parties who are not are obviously the qualified intermediary, a bank involved in the transaction, or the title company. But traditionally, you're giving the identification to the qualified intermediary.
Got it. Todd, just a relating question since we were talking about that, and that is regarding the, of course, timeline. People understand that. Is there any flexibility in the 45-day and the 180-day timeline?
No, and that's really important because then in the 45 and 180 days, those days are set in stone, and not only that, they're calendar days, not business day. And unlike most tax deadlines, it rolls over to I'm sorry, that falls on a weekend or a holiday. It does not roll over to the next business day. So that falls, if your 180th day falls on a Sunday, and most banks won't let you close on a Sunday, you've lost 2 days because you're closing on a Friday. The only time they can be extended is when there's a federally declared disaster, and it affects the taxpayer. And my company regularly posts on that. And unfortunately, we're at the time of the year when there's hurricanes and things like that. So, California wildfires that we had about a month or so ago, 2 months ago, we're always posting, and those people get extensions. The only other type of extension is to get called up to active military duty and get stationed in an active combat zone. So an extension is not something you can file for. The way I always explain it is an extension is something that happens to you, whether or getting called up to active military duty. And I'll say in my 27-year career, I've only had one taxpayer get called up to active military duty and get an extension, but we have had, hundreds, if not thousands of people that are affected by federal disasters that get extensions.
Got it. Thank you.
Okay. So now comes the portion where we talk about reverse exchanges. What we have been talking about are forward-moving exchanges. Forward-moving exchanges account for probably over 99% of exchanges. And again, that's the easiest kind of exchange, the most common kind of exchange. You're selling first and then using that money to purchase. And by the way, a reverse exchange is not, oh, I found this property, let me go into contract, but with a long hold period on that contract. And then let me quickly sell something and structure it as a 1031 exchange. As long as you're selling before you buy, it doesn't matter the order in which you enter into contract. So that's not a reverse exchange. A reverse exchange is that unique circumstance when you need to buy before you sell. Okay. Now, it's a great tool because it allows you to go out in a market that is hot. And, in different areas of the country, hotels or different types of property are either hot and cold in different areas of the country. For example, I think it's this week, or at least within the last 7 days, there was an article in the Wall Street Journal that talked about, for all the problems New York City has, hotel properties are pretty hot in New York City. Right. Conversely, there's also articles in California, specifically Los Angeles, where minimum wage guidelines are putting pressure on hotel owners. So when you look around the country, there are areas of the country that are doing better for hotels and areas of the country that are doing worse. So maybe you're somebody in LA and you're saying, wow, I see the writing on the wall, it's $20 minimum wage. Next thing you know, it'll be $30 and I'm not going to make any money. Let me go to New York City. And you sell from that market and you'd like to buy in New York City where it's a hot market, and you find something right away and you have the cash to make that purchase. You can structure that as a reverse exchange. That's what a reverse exchange is, when you're buying and actually taking title before you sell. And with these next few slides, I'm going to go through it. An overview, though, this slide, what I'm talking about here is all of these type of exchanges are known as parking exchanges. So in addition to a reverse exchange where you buy first and then sell, there's also an improvement exchange. That's where you sell first and then you use the money to improve a property that you're buying. So you could buy, again, this conversation is a little bit hotel centric, given for most of the people on this webinar. Mm-hmm. You could buy a hotel that maybe, the prior owner let get run down a little bit. And you could use some of your 1031 money to buy that property and the remainder of the 1031 money to improve that property. And you'd have to make the improvements within 180 days. And the last category of parking exchange would be a reverse improvement, which is a combination of the two. You could buy that hotel that maybe hasn't been loved in a bunch of years and add money to it to improve it, and then eventually you sell that other property within 180 days to pay for that purchase and those improvements. And the reason why we call it a parking exchange is because in a reverse exchange or an improvement exchange, the taxpayer is not allowed to own what they're selling and what they're purchasing at the same time. So, so the property is quote unquote parked with the qualified intermediary. And that's really just a fancy way of saying we're forming a single member LLC. And again, in the next couple of slides, I'm going to go through the structure. And the money is loaned either by the taxpayer or a bank, normally a combination of the two, to us to make that purchase until the other property is sold. So let me explain a little bit more, and then I'll go through the reverse exchange structure. In a reverse exchange, everything is reversed. You're going to buy first, and again, that purchase has to be structured with a qualified intermediary, and everything is reversed. So the property that you're going to sell has to be identified within 45 days. Now, for most people, they would say, well, yeah, of course, that's the property I'm selling. But when you deal with a large company, they may own several hundred properties. So they're going to identify the property that they may sell within 45 days. And the LLC that we form to purchase the property, is what's known as an exchange accommodation title holder, or EAT for short. That's the maximum period of time the EAT can be on title. Okay. So in what's called a replacement property parked exchange, the qualified intermediary, or more properly, the EAT, the exchange accommodation title holder, takes title to that property that's being purchased. Sometimes there's duplicate transfer tax issues and duplicate title insurance premiums in some areas. I'll tell you that that's very, very rare. States such as Pennsylvania and Maryland sometimes have those issues. New York, New Jersey, Massachusetts, Connecticut, Texas, Florida are all examples of states that do not have duplicate transfer tax issues, and in most cases, duplicate title insurance. Because remember, we're going to take title as a straw man, and then eventually we're going to deed that to the taxpayer to complete the exchange. So there's actually two transfers. So one or two states in our union get a little greedy and try and charge the transfer twice, even though they really shouldn't, because there's no change in beneficial owner. We're technically on title as your beneficial owner. Now, banks will loan into the structure since we're on title. Those loan documents have to be non-recourse to us. So to explain further, let's say, Rav, to use you as an example, let's say that you want to buy this hotel for $5 million as a reverse exchange. Mm-hmm. You have $1 million to put towards the purchase price, and you're going to borrow from a bank $4 million, okay? But we're going to be on title since it's a reverse exchange. We will sit down, we'll get on a call with the bank and say, listen, we're going to be holding on to this property for the first 180 days. So we're going to sign the note and mortgage. Yeah. And so you, bank, are going to have what you negotiated. You're going to have a security interest in this property, even though it's not RAV on title, it's legal 1031 on title. However, RAV, if they, you know, as a requirement of the loan, if they want some kind of personal corporate guarantee from you, that can be done and be done in a separate document. But for us, as the accommodator helping with this transaction, we just don't want any liability beyond helping you with the transaction. So the debt can't be recourse to our company. As much as we like to say we partner with our clients, we don't want to partner on the debt portion of that, and we don't want to be liable for that. And what I'll say is I've been doing this 27 years, you know, going back 20, 25 years, convincing banks to do this was a lot of work and a nightmare. Just about all banks, from the big money center banks to the smallest of credit unions, they're all on board with this now, pretty much. And it's a much easier conversation these days. So basically, what the structure does, it allows for flexibility in financing as much as you can to buy this property. Because remember, a reverse exchange is always you're buying first before you've sold, so you don't have that cash yet, and that's one of the restrictions of a reverse exchange. A lot of people say, "Well, I'd love to buy now. I just don't have the capital to do that." So, one of the restrictions of a reverse exchange, why it's not used more, is you do have to have that capital.
That's right.
Something that I'm not going to go into today is you can also park the property that you're going to sell first, and then just buy the replacement property. The second bullet point really is the reason for doing that. If there's duplicate transfer tax issues like Maryland, I think it's 4%. You'll pay 8% then in that transaction. So sometimes people prefer park the relinquished property. It's much, much more rare though, because in those cases, there's like kind of restrictions on financing and other items which make it less attractive, which is why in the interest of time, I'm just talking about the replacement property parked exchange.
Great.
So
just as a time check, we have less than 15 minutes left for the call. And we have a few questions that are also coming up. I just wanted to let you know that in terms of time.
Perfect. No, appreciate that. We're going to be out of reverse exchanges in about 2 or 3 minutes. And then what I'm going to do is I'm going to buzz through the one big beautiful bill. I'm not even going to discuss them too much, except just to point out some highlights. And then we'll jump right into some questions. So I think we're doing well on time for the amount of information we're trying to give. So this is what a reverse exchange looks like. The EAT, again, is just an LLC that we form. So if you say, hey, I'm going to buy a hotel in Florida, we'll form a Florida LLC. And then what happens is the taxpayer will loan the EAT money. Don't be misguided by the arrows. It should be the other way around. The taxpayer is loaning the EAT money, and maybe there's also a note that they have borrowed from the bank and funded the EAT. So let's say we're buying a property for $4 million. Maybe the taxpayer loans the EAT $1 million in cash, and we get the remaining $3 million from a lender. We then take that money, use it to buy from the seller that hotel, and we get a deed. Now that that new LLC, we're on title to that property. We own that property on behalf of the exchanger. Now, we're not in the hotel business. So once that's purchased, we'll enter either into a management agreement or a triple net lease with our client. That way they have use, occupancy, and control of that property. So it's not like you have to wait 180 days until you sell to start using that property. The minute we take title, the taxpayer, basically can start using that, and that management agreement or lease is how they get use, occupancy, control of that property. Then in the second step, the last step, the taxpayer sells the property to a purchaser. You'll see that little line that says deed, and then the buyer pays to the EAT the net proceeds, and we use that money to pay back the taxpayer the money that was loaned to us to make the purchase, along as paying down the bank. And then once that happened, you'll see it says deed. More often than not, we're actually not deeding the property to the taxpayer to complete the exchange. We're transferring the membership interest in the LLC to the taxpayer. That way, all the loan documents can stay in place, the title insurance documents can stay in place, and many times it's to avoid duplicate transfer tax as well. So the easiest way, and a reverse exchange is a difficult thing to understand. The best way to think about it is this. We're going to form an LLC, and we're going to borrow that money to buy the replacement property. And then once the relinquished property is sold, you're using that money to pay back the taxpayer. Debt is the mechanism. Debt is the bridge between getting the value from the sale property into the replacement property. So we're borrowing first to make that purchase and then selling to pay off that debt. And that's how you get the value of the sale property into the purchase property. So again, a reverse exchange is a great tool if you have pressure of the market and need to purchase first. Okay.
And I would say contact you really to understand if one applies better versus the other, given the scenario that you may have, because you may suggest, hey, I'm glad you're thinking this way, but you really have to think about X, Y, Z that you haven't. Therefore, this makes better sense for you than the other, right? And so they can
It's a
discuss that with you.
very Yeah, it's a very good point. And by the way, a reverse exchange is on average 4 or 5 times more expensive than a regular 1031 exchange, and that's just for our fee. Then normally the bank is going to charge you more of a fee. A lot of times your attorney or accountant may charge you more of a fee. So it's a great tool, but it's used sparingly because there's all these expenses and complications on it. Okay.
Okay.
Now I'm just going to buzz through, what passed the one big beautiful bill, to highlight some of the things that were enacted that affect real estate. Obviously, it's more than just real estate, but the highlight is going to be real estate. 1031 exchanges, and this is so new. You'll see we haven't even like colored in our slides or anything or made them the same because this is so new. Basically, 1031 exchange has remained untouched. What a lot of people forget is in 2017 with the Tax Cuts and Jobs Act, 1031 for real estate remained untouched, but there was a whole category of personal property exchanges that that they did away with. So half of 1031 got chopped basically 8 years ago.
Okay.
So this time they left us alone. So carried interest and qualified business income deductions, carried interest rules remain unchanged. The qualified business income deduction was made permanent because there was a sunset provision in the Tax Cuts and Jobs Act, and the 20% pass-through of the income deduction was preserved. Opportunity zones. This is another tax deferral mechanism where if you sold an asset, and it didn't even have to be real estate. So most of what went into opportunity zones was from the sale of businesses or stocks, things that didn't qualify for a 1031 exchange. You could defer your tax, and the tax deferral lasted up until the end of the year in 2026, and you got a deduction off of your gain. The reinvestment deadline is extended to 2028. Now, from when you make a new investment, there's a 5-year fixed deferral window. You get a 10% step up in normal opportunity zones and 30% in more rural zones. So that's your forgiveness on the gain. And there's new opportunity zones that are starting in 2026.
Mm-hmm.
Bonus depreciation and Section 171. This is a big one. Part of this will affect hotel owners. 100% bonus depreciation is restored for certain types of property from 2025 to 2029. And that's most notably for car washes and convenience stores enjoy 100% bonus depreciation. Section 179, you get $2.5 million worth of value. It phases out at $4 million. This includes qualified improvement property, used property, and certain software. Enhanced interest deductibility, now based on EBITDA, not just EBIT. It increases allowable interest deductions, and it benefits developers with interest projects. Basically, it includes amortization and depreciation, whereas before it did not. And most importantly, and I started out talking about this, the estate and gift tax exemptions. The exemption is increased to $15 million a person. Don't quote me on this, but I think that's up from $12 million. So in 2026, so everybody stay healthy for the remainder of 2025 because the interest deduction, the estate tax deduction goes up next year. It starts being indexed for inflation starting in 2027, which is good because the exemption for estate and gift tax was always a certain amount. And as time went by and inflation ate into it, the value of that went down. So at $15 million, married couples can now protect up to $30 million. And that's pretty sizable at this point. And I think that this is the last slide. The SALT cap. So the state and local tax, which is referred to as SALT, The Tax Cuts and Jobs Act limited the deduction to $10 million. 10 million, we wish, $10,000. So now they increased that back to $40,000. Again, that sundowns in 2029. It phases out above $500,000 modified adjusted gross income. So if you make above $500,000, it starts to phase out. And then the standard deduction is $15,000 for single and $30,000 for joint tax filers, and that begins in 2026. Oh, and yep, one more. Yeah, just planning considerations. This is just talking about reviewing estate and gift strategies and OZ and things like that. So that was really the last slide. So basically, to sum everything up, I know that Rav had talked about this, getting us involved early on, discussing things can help you understand your options, and that's what we're here to do. Rav, I put it back to you. I'm going to stop sharing my screen. We could open it up for questions.
Sure. Thank you. Thank you, Todd. This really helps a lot. And, we want to mention that we're not CPAs, right? I mean, Todd's a lawyer, but he's not giving legal advice. I'm a broker, I'm an agent. Of course, you have to go to your fiduciaries, your CPAs to get more advice. There's a lot of webinars that are coming out right now talking about the tax bill and what it does for you as owners. We will be putting something together in the next maybe couple of months, bringing in an expert who'll talk through how this could be a game changer, especially the 100% bonus depreciation, because a lot of people have questions on that as a tax benefit, as a tax strategy. So look out for that in the near future. So just a couple of questions that I'm going to address, and then I know we're running out of time. Todd, I've already put your information in the chat, so people have your information. They will be giving you a call, hopefully, so they can directly ask some of these questions. But one of the questions that came early on was that if we're buying a hotel and the hotel has, of course, FFE, and you're paying goodwill to purchase the hotel, without that, it's really not a hotel. Why is it that we're not able to then use that towards a 1031 exchange? Because specific question is why FFE and goodwill cannot be exchanged if hotel is bought with, when the hotel is sold. So hotel includes everything. Hotel is not just a hotel because it has FFE and goodwill that's coming with it.
You can't use 1031 funds to buy anything that's not real estate because of the provisions of the Tax Cuts and Jobs Act in 2017. Before that, you could do exchanges of personal property. So if you were selling one hotel that had all the furniture and other things, you could do an exchange of those type of properties when buying another hotel. Now, their like kind did mean like kind, so it was like hotel furniture for hotel furniture. You did two exchanges. You did the exchange for the personal property in the hotel, and you did an exchange of the real property. In 2017, that tax law, the Tax Cuts and Jobs Act, did away with any exchanges for personal property. So you can't buy or sell anything that is not real estate. So goodwill, personal property, furniture, things like that, franchise rights, it all doesn't qualify because it's not real estate.
And I would say, when you guys are doing a deal, when you're working towards a deal, contact your broker as well as your legal professional. I see in a lot of the PSAs and purchase agreements, the allocation is split up front. And people do that for that purposes itself because they want to put a lot of that allocation towards the real estate so then they can have more money on their 1031 exchange site. So definitely it pays to talk to your CPA, to talk to your lawyer, to get that advice from them. Just a few other things in regards to if you want to sell a hotel, can you take that funds and put towards a new build, to a new hotel?
Yeah, you can, but the issue with that is you can do an improvement exchange, as I very briefly touched upon, but from when you sell, you have 180 days to get that money into the new deal. So, what I refer to as stick building from the ground up, pouring a foundation, putting the steel up, that all takes a tremendous amount of time. So you very rarely see an improvement exchange where you build from the ground up. I have some clients who own triple net lease, fast food franchises like Burger King's and things like that. They can build a building like that in 180 days because they do it modular now.
Sure.
They
So
pour the
fast.
foundation, they
Right.
truck in the building, they bolt it together, it's done. You're not going to build a hotel in 180 days. Can you buy a hotel or another property that needs to be rehabbed within 180 days? With work, you can.
Mm-hmm.
And that's the main restriction of an improvement exchange is just this
Got it.
time deadline that you have to work with.
Right, right, right. And folks, I know we're out of time. There's are some other questions that are already here, in which I would recommend that, we've put Todd's information in the chat. Just contact Todd directly, schedule some time with them, because you may have a burning question that you may need answer for, and we may not even do justice by just spending 30 seconds on it. So definitely, I would encourage. We have a professional that is willing to give time and hopefully work with you on your next 1031 exchange. So definitely contact Todd. But I hope this was insightful. I hope this was helpful in regards to just even touching a little bit on the subject of 1031 exchanges, and if maybe reverse 1031 exchange makes sense for you. If there's other topics that you have in mind that you think would help you, and we could bring in a subject matter expert who can talk through and let us enlighten us regarding that subject, please email me. Let us know what those questions you might have, where we can bring an expert to answer those questions. But once again, thank you, Todd. Thank you very much for coming, spending your time with
Thank
us
you.
today. I think this was amazing. I think these refreshers are always needed, because ultimately we are all working towards the same common goal of just building our portfolios and building for our family and building for our future. And so anybody who comes in and helps us, with that, we really appreciate that. I mean, here we're agents. There's KW agents that are here working with their buyers and sellers, and then of course there's the industry which is also here. So I hope they've gotten a lot of value out of it. But I do want to thank you very much, for spending your time with us today. And I hope everybody has a great afternoon. We will see you in the next few months with maybe another topic that we'll bring over. Perhaps that might be on the tax, on the bonus depreciation, where we can really dive deep into that topic and get clarity and get understanding on how we can save money this year in 2025. So thank you again, Todd.
Thank you. Thanks for having me. Thanks again to everybody who attended. Appreciate it.
Thank you.
Take
Thank you,
care.
guys. And we'll talk to you guys soon. Thank you.